Hey everyone, welcome to the KE Report, a Friday daily editorial on January 10th. We are chatting with Marc Chandler, managing partner at Bannockburn Global ForEx, also editor of the Mark to Market website. Click the link in the show notes to visit Mark's website. What we're going to talk about today is recapping the U.S. jobs data that came out on Friday, broadly stronger than expected, how this is filtering into Fed rate expectations, with now rate cuts being pushed out into the second half of this year, and also talking about some of the larger markets out there, currencies, as the dollar continues to dominate, yields continue to rise in the US, also around the world, and we'll, of course, tie in some commodities for all of you, our listeners. Mark, let's start off with that jobs data. Really, across the board, the jobs data was strong on Friday. That pushed down markets and is also, again, filtering into these Fed expectations of less rate cuts and pushing up some of these global markets like the dollar. So, Mark, take us through your takeaway from that jobs data we saw on Friday, please.
So that jobs data was stronger than nearly anybody expected. Not only was the job growth in December strong, by strong I mean 256,000. We've now had job growth of over 200,000 for 3 out of the past 4 months to close last year. But also some of the other underlying measures were firm. And by that, I'm thinking about the private sector. Many people had been getting more pessimistic because they thought we had very weak private sector job growth. This time, private sector job growth accounted for the bulk of that 256,000. 223,000 were the private sector. Meanwhile, the unemployment rate itself slipped to 3.9%, which is really the lower end of a very narrow range it's been in since the middle of last year. I think that the other component here that maybe took people by surprise, manufacturing lost 13,000 jobs. And remember, this is one of the goals of the U.S. is to bring manufacturing back to the U.S. 13,000, which gives back about half of those gains from November. But that was really the only soft spot in the report. Average hourly earnings, 3.9%, which is also the lower end of the range. But the key takeaway from that is that wages in the U.S. are still rising faster than the rate of inflation. And this helps underpin consumption, which is one of the keys to the U.S. economy. We're going to see that again next week. So it's not just that we had strong jobs data, but the jobs data is the first important economic report of a month for the U.S. And from that, economists can forecast. It's an input into other forecasts that economists make. And we look at what's going to coming up next week. We're going to get both measures of inflation. That's the CPI and the PPI. Both headlines are likely to tick up. And then the second half of next week, we get retail sales, industrial production, housing starts. And those three reports from the real sector should also show improvement sequentially. So we're still in this sort of mode of U.S. Outperformance. And this is, I think, what the driver is, lifting the dollar. We saw the dollar index approach 110 this week, right after the jobs data. And the next big level is probably around 111.
Well, Mark, all things considered, one would think that the strong jobs number indicates a healthy economy. Also, the fall in the unemployment rate and the fact that the jobs sector, beat was led by the private sector, not the government sector, which so many people have been shellacking the news saying it was all government jobs. Now we show private sector jobs improving. You would think that would be a boon, but when you combine this information with the expected uptick in inflation that we're going to see next week, it has market participants more focused on how this is going to move the needle for the Fed. And they've now, as Corey mentioned in the onset, moved the idea of more rate cuts back to the second half of the year. So instead of celebrating the fact that we have lower unemployment and better jobs, people are kind of bemoaning it and saying that that's behind the market sell-off. How much do you read into that, I guess, forecasting of what the Fed is going to do now?
Yeah, so maybe unpack that a little bit. The first part, I think, about the Fed expectation, and I think it's true. The market has been slowly becoming more hawkish in the Federal Reserve. Remember, in December, the Federal Reserve summary of economic projections had the Fed cutting 50 basis points this year. The market hasn't been there for a while. In fact, as of the end of last week, after that jobs data, the market is pricing in 30 basis points of cuts. What does 30 basis point mean? It means there's one cut fully priced in and about a 20% chance of a second cut. We've had some banks have given up on the idea of a cut at all for this year, and others have just scaled back. But I think that the backing up of these Fed expectations is important because, to your point, we've seen a big jump in U.S. yields. Since September, when the Fed made that 50 basis point cut, the U.S. 10-year yield has gone from about 3.6% to about 4.8%, 120 basis point rise. How do we explain that rise if the Fed cut? Well, first, I look at the break even, and that tells us what inflation expectations have done. And the break even is really just the difference between the conventional 10-year yield, 10-year bond, and the inflation linked security. That has gone up roughly 40 to 50 basis points. So out of that 120 basis point rise of the 10-year yield, about 40 or 50 of those basis points is probably from just higher inflation expectations. But the bulk of the rise of the 10-year yield, I think, can be explained by exactly what you're saying, Chad, and that is the rise or the shift in expectations about overnight money. The December 2025 Fed funds futures has risen by about 200 basis points since the end of September. And this is as the market had been pricing in very aggressive Fed cuts to now being more hawkish than the Federal Reserve. So I don't think that the backing up of yields is a sign of the Fed's lost credibility or anything like that. I think it's just simply can be accounted for by these two factors: rising inflation expectations and the change in overnight rate expectations. Stock market, though, what a different story. You would think, as you said, strong jobs data should be good for corporate America. However, so much has been priced in. The stock market seemed rich. It seemed to me that, and I think we talked about this at the end of last year, how much good news had been pumped into the market and how it was stretched on a valuation basis. Truth be told, the U.S. stock market peaked over a month ago. I'm looking at the S&P 500 peaking just shy of 6,100 on December 6th, which was the last U.S. employment report. Today, before the weekend, we approached 5,800. We got down to about 5,810 on the S&P 500. So I think this is just like a healthy correction, long overdue. And the key level I'm looking at is really just below what we saw on Friday, which is about 57.85. And that is the top, I should say that's the bottom of an old gap left on the charts from early November, which is we gapped higher right after the election. And that on November 5th, that was the high in the market, and the S&P 500 up shy of 57.85. So that's what I'm thinking we're headed toward. Just give us a little bit more follow through next week.
It is interesting to watch these markets and really understand, too, that there's a few different factors at play, and fairly consistently, good news is not reflected as positive price moves for the markets because of how much everyone carries over to the Fed expectations. But that's why I think it's interesting to look at the US dollar and the bond market, because those do show, I think, more of a global picture in terms of what is driving these different currencies, these bonds, and overall the economies. Does this mean, Mark, that we all need to readjust some of our perceptions that 2025 was going to be a rough year for the US economy, either just because of politically with a new president coming into office, or simply because of the fact that it's been a strong economy and the rest of the world seems to be struggling so much that a lot of people jumped on that bearish or negative outlook for 2025 for the US?
Yeah, I don't know. Through the first part of January, I'm not sure I'm prepared to change like my ideas for the full year. I'm one of those people that do think that the economy is slowing. And I think we're going to still see that here as we get to Q4 GDP. I think the Atlanta Fed, their tracker is looking for something a bit weaker than it has been, something like 2.4 or 2.7%. So I'm not sure that this really is going to change things very much, but it definitely shows the U.S. economy having some good momentum as we enter the new Trump term. I think you're right, too, that the news in the rest of the world is poor. We've had some poor economic data from the Eurozone, from Japan, And it's not just the economics, but think about the politics. Germany, Spain, and France still do not have a 2025 budget. The French have not, they've had four prime ministers in 2024, and the last one, not clear that he can pass the budget, even though he's looking for somewhat less budget cuts than the previous prime minister. Germany has an election next month, and the AfD, their far right party, has been doing pretty well in the polls. Japan has a minority government for the first time in history. The Austrian government recently collapsed, and for the first time, the far right has been invited to see if they can put together a parliamentary majority. We know conflict between Russia and Ukraine continues. We know China continues to be aggressive in their part of the world. And I think that the U.S. still looks like the driest towel on the rack.
Yeah, Mark, it could be the cleanest shirt in the dirty laundry bin, but it's definitely standing out the U.S. economy over what you're seeing in Europe and even what you're seeing in Asia. I guess I just have a question since we've been talking for years now about this. The recession that never came, like a couple of years back, we had those two negative quarters of GDP where people thought, okay, well, that's kind of a textbook definition, but people then came out with new textbooks and said that's no longer the definition. That's not a recession. But we did see a correction in 2022 that tied in with that. We had those bank concerns, the regional bank failures, and all that. But now, a couple of years later, people are still worried about this recession that has never come after years. And maybe eventually we get a recession. But at this point, can't, with GDP, even if it's revised down to 2.4%, that's still growth. Over 2% growth is better than a lot of the world's doing. So can we say that the recession did not come and that we had a soft landing? Is that enough criteria over the last couple of years that the Fed could take a victory lap and say, hey, we actually had a soft landing?
Yeah, I mean, partly I agree with you that the U.S. economic performance has really been better than anybody, including Federal Reserve officials themselves, had thought. I'm not sure, though, that I will accept that the business cycle itself has been repealed. There's several reasons why the U.S. business cycle has been extended. And one of them is who would have thunk that the U.S. would still be spending 6%, the government that is, spending 6% more than they're collecting in revenues. That is to say, we have a large budget deficit, which is a key part of the growth. And that is a political choice more than an economic development, I think. But I think that it's true. The resilience of the U.S. economy stands out like head and shoulders above most other parts of the world. I'm just not convinced that it's completely over yet. But I think that the soft landing, I think that the reason Federal Reserve Chair Powell, has not declared this victory is because inflation is still elevated. If inflation were to get back closer to target, 2%, and we still have relatively firm labor market, I think the Fed could declare a victory. But until inflation is back towards target, it's not clear that we've engineered the soft landing, even though the economy is doing well, it's coming at a cost. And that cost is higher inflation. That said, after January, I think we're going to see a sharp drop in CPI as last year's jump from Q1 drops out of that 12-month comparison. So I think that what happened in December is that the Federal Reserve pivoted from their concern about the unemployment. Remember that Psalms rule seemed to have been triggered. Federal Reserve got concerned about that. And they cut interest rates. And that's why, to the extent that we have the soft landing, I'd say 100 basis points off the Fed funds rate in the last few months of 2024 helped extend what I do think is a soft landing. But the soft landing is part of the cycle. You get the soft landing before it becomes a hard landing. And I'm still not sure that what's going to happen. I mean, who knows what the Trump administration is going to do? How much is just bluster? How much is negotiating position? How much of it's a principled position? And I think about the tariffs and how he's going to fund the extension of those earlier tax cuts. So I think that there's a lot of uncertainty. And typically, you wouldn't expect a recession in the fourth year of a presidential term. No surprise there. But oftentimes the recession comes early in the next candidate's term. So I think that we're still looking at a general slowing down of the U.S. economy. But to your point, the economy still seems to be growing above trend, which makes the budget deficit all the more like as a startling, as a sort of a sore thumb, if you will. How we have a 6% budget deficit or larger despite the above trend growth.
Yeah, and hey, look, many people are always going to be a bit afraid of what could happen to the economy. And it's in the news a lot. So we'll see, and plus that whole wild card of what Trump's going to do. But Mark, let's tie this into the commodities then, because commodities are doing fairly well, even in the face of this higher US dollar and higher yields. Gold's been having a good week. Silver's been doing pretty well. That's above $31. Copper has even had a good week, as well as crude oil. Now, I know a lot of different push and pull factors for each of these commodities, but what do you have to say about continued commodity strength in the face of US dollar strength, yield strength, as we have such a mixed global picture?
Yeah, it's a good point. I think, I mean, we've got a big jump in oil prices. And like you say, gold's been trading firmly too. I think a lot of this has to do with the geopolitics. The U.S. is tightening sanctions on Russian and Iranian oil. I think that coupled with the drawdown we've had in the U.S. inventories helps support the oil price. Gold, I find more interesting. I'm more surprised by the magnitude of the pullback we saw late last year, more than the recovery here. And this week we got up to about almost 2,700. We finished last year near 2,600. The peak last October was almost 2,800. So I think this is still the gold sort of moving higher. I think it ought to move higher. And I think that the uncertainty, the geopolitical uncertainty, and what it means if Trump is going to carry through with his tariff threat. I think this is more of, I think the other factor with gold is that for a while, the Chinese central bank had stopped buying gold. The latest reserve data out at early last week showed that they began buying gold again in decent size. And so I think that prospect, I know many people I talk to are happy to follow what the PBOC does. They buy gold, they're happy they think they've got a big buyer just below them.
Well, Mark, any thoughts on the energy market? Because there's a lot of people weighing in on what's going to happen with the drill baby drill mentality that Trump has. He wants lower gas prices, but if you drill a lot more and produce a lot more supply, that's not good for the oil and gas companies. So they're pushing back saying, we have no incentive to do so, and you can't make us do so. We're not going to drill more. We're going to return, money to shareholders through share buybacks and dividends. What do you make of oil, nat gas, and the energy markets?
Yeah, I don't know. It's hard for me from where I sit to really know like how much the oil company, how much of this is negotiation, and how much of this is boosting U.S. output by 3 million barrels. And we're going to see this next week when the Treasury Secretary nominee appears before the U.S. Congress. And he was one of the people who thought among his different quantitative targets was 3 million more barrels of oil. I'm not sure how we get there, but I'm still impressed by what's happened in the U.S. I mean, the U.S. has emerged as a larger energy producer than Russia, Saudi Arabia, and the U.S., while not energy independent, it's made some really strong strides towards that. So I think that the real thing for Trump administration might not be able to force companies to boost output, but give them access to more federal lands. And I think this is part of the deregulation thrust that has been suggested.
So, Mark, where do we stand heading into next week? Now that everyone is back at their desks, now that we have a Fed coming up that, again, is most likely just going to pause, and who knows what Powell is going to say. We have market weakness here, and that probably is because the Fed isn't going to be cutting as much. But what's on tap for next week in terms of what could be key catalysts and what really matters?
Yeah, what really matters? Isn't that the $2 million question? I think that we're gearing up for Trump's inauguration on January 20th, and I think that the market still has room to run. I think that we're seeing with the dollar is a buy the dip mentality, and I think we're going to see the same thing with the stock market. People have to once it looks like someone else is buying, I think other people come in, and so all we need is like one day, maybe a reversal day. We need something, and once people feel comfortable, I think we're going to see more buying come in to the stock market. There's also like the dip mentality, I think, in many of the U.S. markets. I think next week's U.S. economic data, like I try to sketch out, should be on the firm side, CPI, PPI, as well as the real sector data. I think that we still have to get used to this new era, a return to like the 2016, where Trump's tweets or his messages can roil the markets, and we never know when they're coming. So Monday is a key time, it seems, for many of them. So we'll have to be careful for that. And it's like, again, I think taking Trump seriously, even if not literally, probably the best course there. But in general, I think that the dollar has not peaked yet. I had thought earlier last year that the dollar had peaked, but it's clearer now, especially since the lows from September, that the dollar hasn't peaked, that this was just a serious pullback. And I would be looking for the euro to test parity. I would look for the dollar yen to test that 160 level again. But one thing we haven't talked about, and this sort of at a little bit of a storm this week, is sterling. It was sold sharply, and gilts rose sharply on the back of concern that the economy is weaker than the government had acknowledged before. And at the same time, inflation's proving sticky. The UK is going to have a CPI next week, and they're also going to have GDP figures. And this might take some pressure off of sterling if inflation eases a bit and the real sector stabilizes. But we had a little mini meltdown of the UK gilts in the past week, and it looks like it subsided a little bit ahead of the weekend.
All right, Mark, always interesting chatting with you. And hey, there was a fair bit to talk about at the end of the week and some divergences from, I think, normal trends here as the markets continue to move down. Commodities seem to be getting a buy, and that dollar, boy, oh boy, I don't know what's going to get in the way of that dollar right now, but everything seems to be going in favor of that US dollar. Not that Trump's going to like that. So we'll see again what happens over the next few weeks. And I think your point of not necessarily changing your outlook for 2025 just based on the first 10 days of 2025, that I think needs to be taken to heart by a lot of people who do want to make these grand proclamations. Again, Marc Chandler, managing partner at Bannockburn Global Forex, also editor of the Mark to Market website. Click that link in the show notes to visit Mark's website. Mark, thanks as always for your time. I hope you have a great weekend.
Thank you. Good